In this video, we're going to break down what's happening in the U.S. industrial market as of the third quarter of 2025. Hi, I'm Brandon Avedikian. I'm the founder of Aspire Commercial, a commercial real estate company based in Houston, Texas. I started the company in 2023, and we've since done over 350 transactions and grown to a team of over 25. So let's get into it. We went through the earnings call transcripts of 5 major industrial REITs: Prologis, Stag Industrial, EastGroup Properties, First Industrial Realty, and LXP Industrial. And we went through these transcripts so you don't have to. And we're gonna break down for you the key takeaways for what's going on in the US industrial market right now and how 2025 is gonna end, and then what to expect as we head into 2026. The short version is that the fundamentals are stabilizing, rent growth remains strong, and supply is tightening in most markets. But the way each of these 5 companies that we're going to look into are positioning themselves for the next phase looks very different, especially in the Sunbelt states, including Texas. So let's get into it. We're going to start with Prologis, the heavyweight of global industrial real estate, who had another strong quarter in Q3. Their core FFO came in at $1.49 per share, which beat expectations. Their leasing hit a record of 62 million square feet, with occupancy at 95.3%. Their rent growth was massive. Their new and renewed leases were up 49% compared to the previous rates. And this is pretty surprising. I mean, industrial went crazy after COVID, and Prologis did incredibly well. And now that the market has calmed down in a lot of ways, for them to hit record leasing demand with strong occupancy and 49% rent growth, that shows you that the industrial market remains stronger than ever, and there's a lot of momentum even still. And even with the strong rent growth numbers that Prologis reported, they also have about $900 million of embedded NOI sitting in their portfolio through below market leases that they expect to roll in the next few years and increase the rates to market rents. But what stood out most in Prologis's earnings call is the shift that they're making in their business model. And they're shifting from being a pure warehouse REIT to something even bigger. They are really emphasizing the growth into data centers, and they're going to be a power and data infrastructure company in addition to just a pure warehouse company. Prologis now has over 5 gigawatts of data center capacity, either secured or in development, which represents $15 billion of powered shell investment. And even further, every megawatt that they plan to deliver in the next 3 years, they're already in discussions with customers to take that capacity that they'll be adding online. Their solar and battery businesses are also expanding, with 825 megawatts deployed, with a clear path to get to 1 gigawatt by the end of the year. So Prologis is positioning itself at the intersection of logistics, power, and technology. And that is a theme that could define the next decade of industrial real estate for the firm that's dominated industrial real estate in the previous decade. On the demand side, things continue to improve. Large occupiers are active again. Market vacancy has stabilized around 7.5%, and new construction starts are still well below COVID levels. And this sets up well for continued rent growth heading into 2026 and beyond. So we've got strong rent growth, we've got strong demand, and we've got the large occupiers active again, which really is bullish on all fronts for Prologis. Prologis also announced the end of an era on their Q3 2025 earnings call, with longtime CEO Hamid Moghadam stepping down as CEO after 42 years and 112 earnings calls. And with new leadership coming in, he's leaving the company on a high note with some of their best results ever and with serious momentum heading into the end of 2025 and 2026. He will still remain involved with the company as executive chairman, but he will no longer be CEO. Now let's move on to Stag Industrial. Stag's Q3 results told a similar story as Prologis, with steady fundamentals, strong demand, and signs that the market may have found a floor. Core FFO was 65 cents per share, up 8% year over year, and they signed nearly 6 million square feet of leases in the third quarter with cash rent spreads of 27%. Vacancy across the industry is hovering around 7%, and Stag is expecting that to improve by the second half of next year. While Prologis is building data centers and solar fields, Stag is continuing to keep it simple with their single-tenant warehouses in infill markets and build-to-suit projects that generate steady returns. Stag is already through 50% of their expirations for next year, which tells us that tenants are looking to lock in their space renewals early, which is a positive sign for landlords in the market as a whole. The focus for Stag moving forward is consistency. They're going to seek to keep lease spreads in the high teens, grow NOI around 4%, and stick to markets and deal sizes that they know well and have a lot of experience in. Next, let's talk about EastGroup Properties. EastGroup continues to be one of the most disciplined and consistent operators in the industrial REIT space. They reported FFO of $2.27 per share, up 6.5% year over year, and this marks over a decade of uninterrupted quarterly FFO growth for the company. Their portfolio is 96.7% leased, an incredibly impressive number with same-store cash NOI growth at 7% and net rent spreads at 36% GAAP and 22% cash. Tenant retention is sitting around 80%, and their top 10 tenants make up only 7% of their rental income, so their concentration risk is minimal and manageable. They also noted, interestingly, that construction costs are down 10 to 12%, which is welcome news, and that permitting delays are limiting new supply, which is also driving those construction costs down because it's taking longer for the supplies to be needed. And the slow permitting limiting new supply is also going to help absorption, demand, and rent growth. And so in the next 2 years, they're expecting the market to tighten even more. Financially, they're rock solid with their debt to EBITDA under 3x, their interest coverage at 17x, and nearly $500 million in liquidity. Moving forward, EastGroup is planning to deploy capital primarily in Sunbelt markets, including Florida, Texas, and North Carolina. Texas continuing to attract industrial investment due to its population growth, due to its manufacturing growth, and due to the overall business-friendly environment in the state. Next, let's talk about First Industrial Realty Trust. Their third quarter showed steady performance and solid rent growth, the kind of results that you want to see in a normalizing market. Their FFO came in at 76 cents per share, up 8% year over year. Their same-store cash NOI rose 6%, and they raised their full-year guidance to $2.96 per share. Their portfolio currently sits at 94% leased, and they have already made it through 95% of their 2025 expirations through the end of Q3. And they saw a 32% cash net rent increase with those expirations. And for 2026, they have already addressed 31% of their expirations and are seeing 31% rent growth. Like the other REITs, they are also bullish heading into 2026. They highlighted some development wins in Phoenix, Miami, the Inland Empire, and Dallas, all high-demand logistics markets that are important for First Industrial. Management specifically called out Houston and Dallas, along with South Florida and Nashville, as their top-performing markets where they're seeing strong rent growth and tenant demand. Houston, in particular, continues to benefit from a diversified tenant base from energy, logistics, and manufacturing, with developers staying disciplined on new supply and that new supply leasing well. First Industrial is planning to keep its development focus in these same Sunbelt and gateway markets, and they are targeting 7% yields and 9% IRRs. Overall, their message was that they're going to stick to discipline. They've got strong leasing, they've got a controlled pipeline, they've got low debt and improving tenant sentiment, and they are bullish on a strong 2026. Lastly, we're going to cover LXP Industrial Trust, who had one of their best quarters in years. Their big headline for the quarter is they sold 2 vacant 1 million square foot developments for $175 million. One of those developments was in Central Florida, the other in Indianapolis, and that $175 million sales price was a 20% premium to book value. This single deal improved everything for the company, with their occupancy jumping 400 basis points, their leverage falling from 5.8x to 5.2x EBITDA, and their FFO rising 6%. They used the $175 million proceeds to retire $140 million worth of debt that was at 6.75% interest, which will save them about $12 million per year in interest and operating costs. The result is lower risk, lower debt, and higher earnings, and that is exactly what their investors want to see in this environment heading into 2026. Occupancy in their portfolio is now 96.8%, with same-store NOI up 4% year to date. Their rents are growing at 3% annually, and their leases rolling in 2026 are 31% below market, giving them a solid foundation for rent growth next year. Their focus remains on 12 target markets across the Sunbelt and lower Midwest, which makes up 85% of their portfolio. Markets like Dallas, Houston, Phoenix, and Indianapolis continue to see strong absorption, with construction starts down over 70% since 2022. Lexington Property Trust is not chasing acquisitions at this time. They're focused on internal growth, increasing their rents, and doing selective redevelopment. They just raised their dividend by 3.7%, signaling confidence in the future cash flow of the company. LXP's approach right now is simple: recycle capital out of slower markets, reinvest in core Sunbelt markets, and maintain one of the youngest portfolios in the sector. When you take a step back and look at all 5 companies together and what they reported in Q3 2025, the message is clear. The industrial market has stabilized, rents continue to grow, often in the double digits, and construction pipelines are shrinking fast. The Sunbelt, especially Texas and Houston, continues to attract the most attention from tenants and from developers and investors. Nearly every REIT highlighted these markets as outperformers in their Q3 results. Demand is shifting towards newer, energy-efficient, well-located product, with older buildings and not as strong of locations starting to lag. And another positive note, large corporate occupiers, specifically 3PLs, manufacturers, and e-commerce tenants, after being hesitant and on the sidelines and waiting to see what happens with tariffs and other economic issues, those tenants are starting to move again and become active. And so Q3 2025 was about stabilization, and Q4 2025 and 2026 could mark the start of a slow but steady reacceleration in the U.S. industrial market. And so this was your Q3 2025 industrial market recap. We went over 5 earnings calls from major industrial REITs, and we condensed it into what actually matters for you. If you found this helpful, be sure to hit subscribe for more market breakdowns and real estate insights that cut through the noise. Again, I'm Brandon Avedikian, founder of Aspire Commercial. Thank you for watching, and we'll see you on the next one.